Today, America hears from Jay Powell and Steve Mnuchin, the two men financing the economy throughout the pandemic crisis. Plus, parts of America can eat inside restaurants again, but investors are still betting on delivery. And you're not the only one doing home improvement projects. We've got the latest sales numbers for Home Depot. I'm Mackenzie Sigalos, and this is CNBC After Hours, Work From Home edition. Let's take a look at the scoreboard. Stocks tumbled lower today, and the Dow took a dive after yesterday's massive 900-point gain. Why? Well, one big reason is this article from Stat News, casting some doubt on the viability of yesterday's promising news about an early-stage vaccine trial from biotech company Moderna. This all boils down to optimism, right? Well, what I mean is, it's looking like stock market investors are so eager for some optimism. Vaccine development going well? Great. That means people get inoculated, they're not scared of getting sick, and they go to stores, and the economy goes back to normal, and this whole nightmare is behind us. Time to buy. Now, this is certainly an oversimplification, but it's also why when an article like this comes out, it can knock down the Dow by over 100 points. And take a look at Moderna stock. It plunged more than 10% today on the snooze. And now for three of today's biggest developments in the global coronavirus pandemic. First, Federal Reserve Chair Jay Powell and Treasury Secretary Steve Mnuchin testified virtually in front of the Senate Banking Committee today to update the public on the state of the trillions of dollars of coronavirus relief. Now, these two guys are exactly the people we want to hear from, since they're effectively in charge of financing the American economy throughout this crisis and getting all of us out on the other side of it. One of the biggest things to come out of today's hearing, both men reiterated that there will likely be more economic pain ahead of us. And Powell remarked that the unprecedented size of this stimulus might not even be enough.
This is the biggest response by Congress ever, and the fastest and the biggest from us. And still, this is the biggest shock we've seen in living memory. And the question looms in the air of, is it enough?
And second, sales numbers for the big box retailers are soaring in the coronavirus economy. We heard from two of them in earnings reports this morning, Walmart and Home Depot. They both saw higher sales as consumers turned to them for all sorts of goods during quarantine. Now, Home Depot sales rose 7% as the warm weather and lack of social options presented the perfect conditions for some home improvement projects. And then there's Walmart. Their online sales alone surged 74% as more Americans opted to shop from the safety of their homes. And it appears consumers are shopping less, but buying more per trip. Walmart said the average price of each full cart increased 16%, but the number of transactions themselves dropped by about 6%. Now, with bigger sales came bigger costs. Both companies spent close to $1 billion last quarter in coronavirus costs, including increased cleanings and higher wages. But these reports were one of our first looks at the hard numbers behind how this pandemic is shaping up shopping behavior. The big question is, how long will these new conditions continue? And will shoppers go back to their old habits or stick with these new trends? Finally, a 32-year-old Texas man has been charged with allegedly filing fraudulent COVID relief loan applications to the tune of $5 million. He allegedly applied for the government-backed loans through two different banks, claiming to have over 400 employees on his payroll when, in fact, he had 0 employees working at the supposed businesses. Now, according to the DOJ, the man allegedly copied a list of names off the internet and claimed them as his employees. This is at least the third case of fraud associated with the $2 trillion CARES Act passed by Congress earlier this year, which was meant to lend a lifeline to struggling individuals and business owners in the wake of the coronavirus crisis. Okay, let's get to our sound check. Here's a roundup of the day's biggest action and what the top newsmakers and business leaders had to say on CNBC's airwaves today.
You got to look at things like daily and weekly data. And we have a lot of that from private places like Apple Maps mobility data, which show that the worst point was early April and that we've now seen a significant uptick in mobility. And you translate that to things like visits to retailers that are compiled by a company called Unicast, same story, down 50% in April, now maybe down only 30%. We may look back and conclude that April was the bottom.
So it's great to be open. It's great to bring some employees back to work, but we're far from profitable. So right now we're just churning dollars. 15 to 20% of America is unemployed, 15 to 20% is scared of losing their job or holding on to their money, and 15 to 20% are just damn scared of going out in public yet. So believe it or not, opening up at 25%, and now we're going to 50% in Texas this Friday, I don't think it's going to have a huge impact on business.
We've sent $150 billion to the states to offset expenses that are even remotely related to COVID. So for one, we've already covered a tremendous amount of it. And, you know, why is it that the federal government should be the source of this money? I mean, states and municipalities have taxing authority of their own. They vary enormously in terms of how much money they choose to spend per resident. Some are very efficient and lean, and they've got rainy day funds. Others are completely insolvent.
If the NBA comes back, Major League Baseball starts, MLS soccer, I think you're going to see all those sports come back, but empty stadiums. Also, probably testing the players. Probably have to do that almost every day, and especially before games. And so, because we need it, America, we thrive on our sports. That's how we escape our everyday life, is to indulge ourselves into sports.
All right, let's turn to the reopening of the American economy. Now that nearly every state has begun to at least partially reopen, we've got to check on one of the industries hardest hit by the coronavirus lockdowns: restaurants. Now, though restaurants were largely deemed to be essential and allowed to operate via takeout and delivery throughout the stay-at-home orders, many owners had to change business models overnight to see if the shift was economically viable. And now, more than a dozen states have allowed people to eat inside restaurants again, which is theoretically really good from a business standpoint for those companies. But here's the thing. Wall Street is kind of telling a different story. Shares of the companies that are best built to thrive under delivery-only conditions are really outperforming the other restaurant stocks. CNBC's Kate Rogers has more on this tale of two restaurant trends.
Things are starting to look up somewhat for the restaurant industry as restrictions begin to be lifted around the country, according to new data from the NPD Group. The group says that 19 states are now open for some form of on-premise dining. Now, these states may have not fully closed down or have started to lift restrictions. For the week ended May 10th, total restaurant transactions fell by 23%. That compares to a 26% drop the week prior and marks the fourth consecutive week that we've seen some improvement in this transaction data. But comparing these stats overall to stock performances really tell two different stories. The best performing restaurant names in the sector all have robust delivery and carry-out systems in place. Pizza players like Dominos and Papa John's are up around 25% year to date. Chipotle, which has a really robust digital infrastructure, is up over 20% year to date. And Wingstop is actually the best performing restaurant stock in the sector year to date, up about 45% so far. So I think there's a few different things at play here. Number one is that Americans are very accustomed to ordering pizza for delivery, not just from Papa John's and Domino's, but also from, your local mom and pop pizzeria. So I think that that's what's kind of behind those two stocks being go-tos for investors at a time when many people are really staying home to stay safe. Chipotle's invested a ton of money in both delivery, carryout, and digital as a whole, so no surprise there that investors feel confident about that. And Wingstop's business really is built all around carryout and delivery. So again, no surprise there, but again, far and away the best performer of the restaurant sector. Delivery has also become a big part of the Starbucks story, but it's still something that people are getting used to. So while it's an option, they're more accustomed to mobile order and pay. And just finally, some of the other fast food players obviously are still open for drive-through. McDonald's in particular, drive-through is about 2/3 of its business. But again, they're not necessarily names that you're as used to placing an order for delivery. So while things are starting to open up and get back to normal and diners may be cautiously returning to some form of on-premise dining, it seems that investors are really putting their money behind names that are best equipped to prepare with consumer preferences changing in the new normal.
Okay, and before we leave, it's time for a numbers round. Let's kick it off with 60. Delta will add flights to its schedule through at least July in order to keep its planes capped at 60% capacity, according to a report from Reuters. This news comes after accounts have surfaced of fully packed flights without enough room for passengers to safely social distance themselves. Air travel has taken a major hit from the global pandemic, and airlines are now facing the challenge of reimagining what flying looks like in this new world. For example, one new requirement from European budget carrier Ryanair: passengers have to raise their hand and ask for permission before using the bathroom. Next, 170 million. Viral short-form video app TikTok has 170 million users here in the US. It also has a new boss. Kevin Mayer, Disney's former head of streaming and the man who launched Disney Plus, stepped down this week to become TikTok's new CEO. It's a huge get for the viral social video app. Mayer was a really big deal maker at Disney, helping it become the juggernaut that it is today. He was instrumental in Disney's highest profile acquisitions: Lucasfilm and Star Wars, Pixar, Marvel, and 21st Century Fox. And Mayer's going to have his work cut out for him. Politicians have raised privacy and national security concerns over Chinese ownership of TikTok. And sticking with streaming, we'll finish with 27. Apple TV Plus has 27 original television shows and movies on its website, far fewer offerings than the thousands of options on its chief competitor, Netflix. But Apple is reportedly taking steps to change that. The company is acquiring older movies and shows to try to rival Netflix's deep catalog. The move represents a slight change in strategy for the tech giant, which launched its streaming platform in November with a lineup of originals headlined by top-tier talent like Oprah, Steven Spielberg, and Jennifer Aniston. That's it for After Hours. Stay up to date in real time with CNBC. Get the latest on the threats facing the already beleaguered airlines first thing tomorrow morning when CNBC interviews the brand new United CEO Scott Kirby on Squawk Box. And be sure to catch every development in this historic battle against coronavirus and the unprecedented economic fallout by going to CNBC.com and downloading the CNBC app. We'll be right here in our home office every Tuesday and Thursday with a new edition of After Hours, so be sure to catch us then. In the meantime, stay safe, and we'll see you on Thursday.